Este evento contará con una plataforma dedicada a la transmisión en vivo. Entrando a la página web del evento, eventos.flar.net, podrá encontrar los auditorios de las sesiones en vivo. Una vez en el auditorio, podrá ver la sesión en vivo, participar en el chat y ver información de la sesión, así como la biografía de los conferencistas. Si tiene dudas sobre la usabilidad de la plataforma, puede escribir un correo a comunicaciones@flar.net.
Hello everyone, I am Antonio Candia, Principal of Financial Innovation here at the Fondo Latinoamericano de Reservas, FLAR, and welcome back to another week of our virtual conference sessions. It is said that in order to understand geopolitics and investing, you have to get geopolitics right first. I feel privileged and honored to be here with Marko Papic, partner and chief strategist at Clock Tower Group and author of Geopolitical Alpha, an investment framework for predicting the future, who will assist us in this effort of getting geopolitics right first. Thank you very much for joining us, Marko.
It's a real pleasure. Thank you, Antonio, for the invitation.
And before you begin your presentation, please let us know a little more about your background, included where you have lived and how you ended up here and why you wrote the book.
Yeah, so I was born in Belgrade, Yugoslavia, a country that no longer exists. And I lived in a lot of different places, the Middle East. I finished my high school in Switzerland. I was educated in Canada and the United States. Lived in Quebec for 8 years. I worked at BCA Research, which many of you probably know. It's an independent macroeconomic research firm based in Montreal. And then in 2019, I left and joined an asset management company here in Santa Monica, California, where I am talking to you from right now. And the book, I wrote the book as sort of a bookend on my career as a sell-side research analyst. It's a book that really incorporates my framework for thinking about politics and geopolitics from a market and investment perspective. And so you can think of it as a summary, really, of that part of my career where I was writing research for people in the markets. And it tries to explain that we don't need, to talk to fancy, expensive consultants to get politics right. We as investors can do it ourselves if we just focus on the material constraints that face policymakers rather than thinking about what their preferences are. So to give an example of this, you don't really care who gets elected in an election. What you care about is what is the political context in which that person, that leader faces the future. If the context is favorable, then it's going to be easy for the policymaker to pursue their preferences. If it's not, it's going to be difficult. So that's what the book is about. And now I work on the buy side, so I still write research, but I focus it towards kind of the long-term themes that I think are going to be interesting for investors so that we can launch illiquid funds and private strategies based on this long-term thinking.
Oh, fascinating. And now if you could walk us through these three macroeconomic and geopolitical paradigm shift that you believe will affect investors through the 2020s, please.
Okay, super. Well, thank you so much for the opportunity. I'm going to spend a little bit of time here talking. What I want to say is that this is a pretty long presentation. It has 63 slides. We're not going to go through all of them because I think all of you will be extremely bored if I did that. So I'm going to just look at the highlights. I want to talk about three big picture paradigm shifts and how they interact. And then I'm going to take a little bit of time to conclude into what I think this means for Latin America, which I'm actually quite positive on. Despite the recent political moves, I actually think that Latin America is probably one of the regions that will navigate these paradigm shifts the best over the next decade. The first paradigm shift that I want to spend some time talking about is really one that's much more focused on US politics and has to do with domestic politics in the US. The reason it's really relevant for you in Latin America and for everyone in the rest of the world is that the dollar underpins our global asset allocation. Whether you're sitting in Santiago or you're sitting in Seattle, ultimately you have to make decisions based on where the dollar is going. I call this paradigm shift the Buenos Aires consensus, which, if you're from Argentina, no offense or anything, I had to pick a name, and so I picked Buenos Aires. Why? Because fundamentally, what I'm trying to say is that the Washington consensus, which is a set of best practices that we've experienced as investors since the 1980s, since the Ronald Reagan and Margaret Thatcher revolutions, that set of best practices is dissipating. And what I mean by this is specifically that deregulation, privatization, free trade, counter-cyclical fiscal policy, and orthodox independent monetary policy are all eroding on the edges. We are asymptotically approaching some sort of a Buenos Aires consensus rather than the Washington consensus. Now, I don't mean that we're going to have hyperinflation. I don't mean that we're going to have extreme profligacy and populism. I just think that on the margin, we're moving away from the state of affairs of the last 40 years. And I guess the critical point that I want to make is that the United States of America is moving far more towards the Buenos Aires consensus than any other developed market, any other OECD economy. And this is obviously controversial because what I'm telling you is that the United States will be more populist than Italy, than Spain, than any other country that one would imagine as a sort of a populist economy. And the first chart I want to kind of walk you through here is a chart that all of you already really understand. This is nothing new to you as investors, as economists. It basically shows you the top 10% income share of total income by country. As you can see, the United States of America, that's where the top 10% capture the largest portion of the economy, about 45 to 50%. United Kingdom is below, and then France is there at the bottom. Many of my American clients would say France is socialist. As a result, you can see it only captures about 30% of GDP. Now, you know this, I know this. I'm adding no value by showing this chart. But what I'm trying to show here is that things change, things evolve. Countries move up and down in terms of how they redistribute wealth. And what's interesting to me on this chart is that if you look at the 1950s and 60s, in the 1950s and 60s, it was France and the United States that were the most laissez-faire, that redistributed income the least. The United Kingdom, in fact, was languishing at levels of redistribution that even are more significant than France is today. And then something happened. In the 1960s and 1970s, France became what we consider France today. The United Kingdom and the United States went the other way after the 1980s. What's interesting about this is that France underwent this transformation. The purple line went down. So the share of total GDP that was accrued to the 10% of income share went down significantly in France from about 1968 to 1980. This happened because of domestic political risks in France. In particular, the May 1968 revolution in France was a very significant event. It forced the center-right Gaullist government of Charles de Gaulle, Georges Pompidou, and Giscard d'Estaing to proceed to pursue redistributive policies. And by 1980, France was where it is today, where most people kind of think of France. By the way, the socialists in France were elected in 1980, not in 1968. They were elected at the end of this process. Now, there's a couple of things I want to emphasize here. One, the median voter is the political price maker in the political marketplace. Politicians are simply price takers. Center-right, pro-capitalist, Gaullist politicians in France underwent the redistribution that produced this outcome, not socialists. And I feel that investors, particularly in Latin America, I would argue that investors often overstate who's in charge. I speak to my Brazilian friends all the time. There's a lot of hair being pulled in the region over potential return of PT to government. And I think this is a big mistake. The median voter determines outcomes, not people in charge. That's the first thing I want to emphasize here. The second thing I want to emphasize is that I believe that the United States of America is now proceeding with the same type of redistribution that we saw in France. The reason for this is that in the developed world, the United States of America sits in the most dangerous quadrant. So this here is the Gini coefficient on the bottom, measure of income inequality. On the y-axis is the generational income mobility. how likely are different members of the generation to move up and down in terms of income, in terms of wealth. As you can see, the United States of America is basically the worst in both measures of income inequality and, ironically, for the United States, which prides itself on the ability to move up through different social strata, it actually performs the worst on generational income mobility as well. This is a politically unsustainable state of affairs. It has led to violence and unrest in 2020, and of course on January 6th, 2021, where the capital of the United States of America was stormed and 5 people lost their lives. And it will continue to create political risks that will see American policymakers continue to pursue unorthodox monetary policy and profligate fiscal policy. Now, this is exactly what happened. I've had this forecast for 2 years. This is nothing new. And then, of course, we got the pandemic. The pandemic produced the largest fiscal and monetary policy response we've ever seen before. On the left-hand side, you can see that the increase in budget deficit during this recession dwarfs the previous 5 recessions. And the response in terms of Fed holdings of US Treasuries, so the amount of treasuries bought by the Fed in 4 months during this recession is almost double the 10 years under Bernanke and Yellen. Now, I think the biggest mispricing in the markets today is that most investors look at these charts and they say, Marco, this has to do with the pandemic. This has to do with the COVID-19. It's not a sign of some deeper paradigm shift from the Washington consensus to the Buenos Aires consensus. And I would argue that that's wrong, and it will be proven wrong going forward. One thing that I think is very dangerous is that currently many investors have lost faith in further fiscal policy. As you can see on these 2 charts, this has happened before. The purple line is the 10-year Treasury yield. The blue line is the budget balance, cumulative revisions to the budget balance. In 2017, very similar to today, investors doubted the ability of President Trump to pass the fiscal tax cut plan in 2017. As the cumulative revisions to the budget balance went sideways during this period of doubt, so did the 10-year yield. When investors realized at the end of 2017 that President Trump could actually blow out the budget deficit to pass tax cuts, so did the 10-year. I believe that we're in a very similar situation today, where investors don't think that American policymakers can get a deal on fiscal plan, and therefore the 10-year has sort of moved sideways until September sell-off. And I think that is a mistake. There is more fiscal stimulus coming, and I think it's going to be quite meaningful. The reason that's happening is not because Biden is in charge and Democrats are in charge of Congress. It's happening because of where the median voter in the United States is. On the left-hand side, you can see that percent of respondents who say deficit reduction should be a top priority has collapsed. That's very interesting because what's also collapsed is the budget balance. In other words, in 2011, 12, 13, as the budget deficit of the United States was improving, the number of Americans who were concerned about budget deficit was ironically very high. That ushered in the Tea Party, that ushered in the austerity of the past cycle. We have basically no demand for similar policies today. On the right-hand side is a very important chart. It's a chart that Pew Research has been producing since the 1970s. It shows the preference for small government minus big government in the United States of America. As you would imagine, given that this is the United States of America, the net preference tends to favor small government by quite a large proportion in the early 1990s. But notice what's happened. Over the course of the Obama, Trump, and Biden presidencies, the net preference for small government is now lower than the net preference for large government in the United States. What is my point? My point is that we're overstating next year's fiscal cliff. We're understating the political zeitgeist. If you think about why we had disinflation, if you think about why we had secular stagnation in the last cycle, sure, there was household deleveraging, which I think is extremely important and is over, by the way. But the second reason is fiscal policy. Fiscal policy in the last cycle was negative for growth. The G in the GDP equation detracted from growth for basically 5 years. You can see that here. We had a long, drawn-out, policy-induced fiscal drag on growth, which was the product of the Tea Party pushing President Obama to cut spending. That is not going to happen this time around. Obviously, we will have a very sharp fiscal cliff next year in 2022, but that's a product of math. That's a product of rate of change from 2021. It's not a product of policy. In fact, I would expect that they will pass more spending this year and that you will have actually a persistent, mild, and likely unnecessary positive contribution to growth from fiscal policy going forward. That is a major difference between today and the last cycle. In fact, if I was to compare what today looks like, I would say it looks like the late 60s, early 70s. It was a period during which inflation was bid up by precisely the similar policies, in particular fiscal profligacy of the late 1960s due to political risks in the United States. There was the rise of the baby boomer generation, which caused protests, generational change. There was the anti-war protests of the 1960s and 1970s. And there was a pretty violent reaction in the United States to the civil rights movement of the late 1960s. The American government tried to douse these political risks with profligate fiscal policy and loose monetary policy, which produced the type of an inflationary response that you would expect. Of course, the Fed actually countered to this. The Fed was not behind the curve, as many think, pre-Volcker. The Fed was raising rates, as you can see on this chart, and actually produced the 1973-1975 recession. That recession happened basically before the oil embargo started. So if you think about the 1970s, and if you think about the inflationary era, it wasn't OPEC and it wasn't the oil embargo that caused the inflation. What happened was that the 1960s produced the type of fiscal and monetary policy responses due to domestic political pressures that caused inflation to go higher. Now today, the Fed is arguing that inflation is transitory. Obviously, I agree with that to some extent. Much of the demand that we've seen so far is ridiculous and is driven by fiscal policy and household balance sheets. Look at the chart on the left. It is absolutely crazy, if you will. It shows that in 12 years after 2008, durable goods spending in the United States rose by $500 billion in 12 years, from 2008 to 2020. In 12 months after the pandemic, spending on durable goods went up by $1 trillion. That clearly is transitory, and it's something that the Fed can deal with mere interest rate increases. The problem, however, is that if the Fed raises rates and induces a recession, like it did in 73 to 75, it will not help the secular supply issues that are building up in the world. The first of those is the outcome of the US-China tensions. We've had, of course, tariffs raised. We've had kind of a peak of globalization, as you can see here on the left-hand side. This is our trade globalization proxy, which basically began to roll over before Trump, before the trade war. And then on top of that, you had tariffs. The problem with US-China tensions is that it creates a national security prerogative for creating redundant supply. In other words, supply chains, which were finely tuned by the introduction of China into the global supply chain, are now being rewired. By itself, this is not inflationary. By itself, the trade war is something that our world can digest. We can still have a disinflationary context, even in the context of a trade war. But this is not the only paradigm that is occurring. Another paradigm that's occurring right now is, of course, the green transformation. The Capex necessary to rewire the whole planet is going to be gargantuan. Goldman Sachs estimates it at $6 trillion a year of Capex by 2030. IRNA, which is the International Renewable Energy Association, estimates somewhere around $130 trillion necessary to make this happen by 2050. Meanwhile, very little Capex is going into fossil fuels, which is causing price spikes, as you can see with what happened this year with natural gas in Europe. So it's not just national security that's creating supply problems. It's also the green transformation. And all of this is happening in a macro context of very little Capex. So you can see on the left-hand side that over the past decade, for much of the past decade, the capital expenditures, Capex, by commodity mining companies has been very low. Why? Because prices went down. You could basically show oil prices or CRB index nicely kind of, circled around this table, it would look basically the same. Capex in commodities is quite pro-cyclical, and therefore we haven't had enough of it when commodity prices went down. In other words, we're trying to rewire the whole planet for the green transformation. At the same time, the US and China are rewiring their supply chains, and all of this is happening in a context of very limited capex for the past decade. That's a solution for permanent price increases, which is why I think that we are in a fundamentally different cycle, one that will see capex. So this year is just the G3, so US, Germany, Japan, capital goods orders. I think we've seen this extraordinary spike. It's coming off, but I think that this will not be a capex-less cycle. This will be a cycle that will see capex lead. The kind of a capex-led cycle that we had in the 1980s and late 1970s to accommodate the problems of oil supply following the Yom Kippur War in 1973 and China's integration into the economy. Now, does this mean that you should expect hyperinflation? No, no. But even in the early 2000s, we had CPI average from 2003 to 2008, it averaged around 3%. And this is my problem with the promoters of the disinflationary thesis. To me, they're as big of zealots as hyperinflationistas. You have basically zealots on both sides. I am merely saying that inflation can and probably will surprise to the upside. Not extraordinarily so, but can the CPI measure in the United States of America about 3.5% for the next 5 years? Why not? I think it can easily do so, especially when we consider that the biggest reason we had disinflation in the last cycle is not population growth, it's not demographics, it's not technology, it's not Uber, it's not even fiscal policy that I just talked about. It was this chart. Credit to households as percent of GDP. The United States of America, which is the red line up here, basically saw deleveraging in the household sector. Households in the United States just said, hey, we're going to take a break for a decade. And growth became completely leveraged to China, which you in Latin America know very well. You could do all of your global asset allocation purely by looking at what? One variable. Total social financing in China was more important than anything. Well, that world is over if the United States consumer is back and if fiscal policy is not a drag on growth. What does that mean for you and for everyone else in the world? It means that the most important question now is how orthodox is the Fed going to be in light of these inflationary pressures? Right now, if you look at the performance of oil prices and the way that the yield curve usually acts when oil prices go up, we are currently in a late stage cycle environment. The dollar is rallying, and also what's rallying are commodity prices. It's usually a sign that the Fed is about to kill the cycle in the next 12 months, give us a recession. In other words, commodity prices, copper, oil, should be coming down momentarily as the Fed responds to higher inflation. I don't think that's going to happen. I think that the Buenos Aires consensus forces policymakers in the US to emphasize nominal GDP growth targeting rather than fight inflation. And I think you will start to see a pivot in the Fed language towards the non-transitory nature of inflation, but more its supply side nature, something that they cannot fix with high interest rates, which I think is correct, they can't. Watch also very carefully what happens to Jay Powell. As you can see on predicted, his probability of being reappointed has fallen. Everybody expected his reappointment to happen in September. If he's not reappointed and you have a wholesale change in the leadership of the Fed, I think he will entrench this kind of a dovish pivot. Ultimately, the world I think we're going to face is one of hydrogen, high inflation, high growth kind of a world. It's a world that the Fed will usher in by allowing fiscal policy to lead growth higher and by allowing monetary policy to let inflation run a little bit hotter over the next couple of years. Why? Because ultimately you cannot have supply side responses to national security prerogatives and to the green agenda. You can't have supply side responses if you're raising hikes and raising the cost of capital that will be needed to spend all the trillions of dollars of capex that those transitions, those paradigm shifts require. Ultimately, don't forget, raising interest rates ahead of the 1973 recession causing the recession from 73 to 75 did nothing to address inflation. Inflation came back from 75 to 80, not because of oil embargoes, but because Capex was delayed by 2 years when the Fed caused the recession. What does all of this mean? It means for you in Latin America, but really everyone else, if we are in this high growth, high inflation environment, S&P 500 returns should be okay, not as good as in a high growth, low inflation environment, the Goldilocks, but EM returns will be quite well. And so that is a puzzle that's puzzled me and many other macro strategists, why emerging markets have not followed FX and equities with the commodity prices. I think that global investors remain skeptical that we are in a new cycle. And so they have delayed the actual bets on emerging markets going higher. But I think that this is a coiled spring. Look at copper prices, for example, and Latin American currencies. There's a huge alligator jaw chart developing with a divergence between commodities and EMFX. And I think it will snap higher as the dollar goes lower. Obviously, bonds are not a buy in this situation. In a high growth, high inflation environment, bonds don't sell off massively, but they do sell off. Finally, the thing to watch is really the dollar. As I said, right now, the dollar is buoyed by Fed rhetoric. Both the June and the September FOMC meetings basically convinced investors that Marco Papic is wrong, that we're not in the Buenos Aires consensus, that we're in a Washington consensus where the Fed reacts in an orthodox fashion. That's what I think took the DXY from 89 in May to basically 94 in October. But the DXY has struggled to break through this kind of a 94 basis. And I think that it will break further down if the Fed either has a dovish pivot or maintains its current level of hawkishness in face of stickier than normal inflation. So that's the first part of the kind of paradigm shifts. It has to do really with US politics and the mounting political risks. Notice that obviously this is a very important point to make. Populism is not happening everywhere at the same level. It's happening in the US as far as the OECD is concerned at probably the highest level. That's why this is particularly a dollar story. And I think that the performance of the dollar in the back end of 2021 is unsustainable if I am correct that the Fed is going to allow inflation to be slightly higher. Now, the second paradigm I want to talk about really quickly is the Cold War, China-US, and what it means for investors. I think there's a lot of emphasis on this topic, and I think most investors don't really understand where it's headed. I think the term Cold War is being overused and it's overemphasized, and I think it's a really lazy analogy. I think a much better analogy to a Cold War is pre-World War I and pre-World War II era, a multipolar context. Notice that trade between enemies in both historical moments was actually quite positive. So the trade between France, UK, and Russia with Germany went up right up until the war. And the trade between Japan and the United States also increased. Now, in both cases, countries were very much aware that a war was coming. They were very much aware that there was a geopolitical risk, and yet they continued to trade. Why? Because allies don't trust each other in a multipolar context. So in a multipolar context where there's no one or two countries that kind of lead the world, where it's every country for itself, it's very difficult to create alliance structures that keep trade to a minimum. You can see that actually with a stark example today. Australia, which is kind of the West's tip of the spear against China, went out in 2020 and was quite aggressive towards China, asked for a COVID-19 investigation, and China imposed an embargo against Australia. As a thanks for its standing up to China, the United States of America has taken all of Australia's trade with China. So instead of backing its ally up by saying, hey, Australia, we're not going to take your market share in China because you stood up for the West, the United States came in and took all of the trade. This is an environment in which you should not expect a coordinated policy response to China. It's going to be very, very difficult to have a coordinated policy response because allies don't even trust each other. And if you look at, for example, the view of China in the US in Europe, in many countries, in most countries, China has a more unfavorable view. but it's pretty close. It's not that clear that most Europeans favor China or US over China. That's why you should expect there to be some splinternet, some decoupling, some bifurcation, but it's not going to be dramatic. What I'm thinking is that we will have a return to the 1980s, 1990s level of globalization, which was still a globalized world, but there were technological standards. For example, I grew up in Yugoslavia and I grew up in Europe, and it was impossible to watch VHS tapes that my relatives from the US sent me. Many of you in Latin America probably remember this era as well. That was the Pulsecom NTSC kind of a split. Or the chart on the right. When I left high school in Switzerland and came to Canada for my undergraduate degree, my cell phone didn't work. That's the world we're going back to. Is that a world that you should be afraid of? Of course not. It's actually a great world to invest in. So one of my main investment theses for the past 2 years, since the trade war started, is to invest in Capex goods. In this particular case, this chart shows you the performance of our Capex, of our semiconductor Capex index, which is the purple line. These are companies that help semiconductor companies build their fabs. In a world where national security suddenly matters, you will see an overproduction of goods because of national security redundancy. Countries will want to have redundant supply chains. And that will benefit Capex companies. It will also be reflationary and inflationary in the short term. In the long term, we'll have too much stuff produced by too many countries, of course. But from here to there, it will require commodities to build out those fabs and to build out those redundancies. Now, in terms of China itself, my sort of neat geopolitical thesis will be scuttled if China invades Taiwan, if China decides to militarily reunify Taiwan. In other words, the ability of allies to coordinate and have an alliance structure will be much simpler if China is aggressive. It will be much simpler for the United States of America to convince its allies to go with it. So I want to spend about 2 minutes explaining why I don't think China will do anything aggressive over the next 5 to 10 years. First and foremost, China's biggest problem, its biggest constraint is its geography. A lot of investors or geopolitical strategists talk about the first and second island chains that China is trying to occupy or conquer. This is a mistake. The number one critical points for China is the Malacca Straits and the Straits of Hormuz. Straits of Hormuz is becoming even more important for China because over the past 5 years, China has become addicted to Middle East supply of energy. In other words, China can attack Taiwan. It can militarily reunify with its wayward province. That can definitely happen. The problem is that if it did so, it would be without oil if the United States of America imposed an embargo in the Straits of Hormuz. There is no way for China to defend the Straits of Hormuz. It doesn't have the Navy for it and will not have a Navy for it over the next 10 years. Not only is the Straits of Hormuz far away from China, not only is the American Fifth Fleet present in Bahrain, but China would also have to circumnavigate its dear friend India to get to the Straits of Hormuz. In other words, it's not happening. That's the first constraint of China. The second constraint of China is that the Chinese economy is slowing down. And China is increasingly becoming mired in what I call, well, what many call the middle income trap. This chart shows on the bottom, on the x-axis, GDP per capita as percent of US GDP per capita. Y-axis is GDP growth. As you can see, the East Asian economies of Taiwan, South Korea, and Japan, the light blue, escaped the middle income trap from 1955 to 2021. Latin American economies, which is the gray, have been stuck like a wheel spinning in the mud, stuck in the middle income trap. China is obsessed with this issue. If it becomes mired in the middle income trap like Latin America, it will experience the type of political changes Latin America experienced from 1955 to 2021, which means a lot of changes in regimes, coups, and all sorts of instability. China does not want to experience that. But given the deceleration of growth due to demographics and other issues, China has no other choice but to pivot towards more redistribution, towards more income inequality so that it can prepare for a life in the middle income trap. And as it does that, it's going to become more and more dependent on exports, not less dependent on exports, as it hopes to do. So you can see on the chart on the left-hand side, you can see that exports have become the only source of growth. That's the light blue line. From 2020 to 2021, last 2 years, exports have become the only source of growth in China. And that's no doubt because unlike America, which deleveraged its consumers last decade, China leveraged its private sector. Chinese consumers, Chinese domestic consumption is going to be weak for the next decade. And if its domestic consumption is weak, then how is China going to pivot away from exports and investment-like growth? They just won't do that. The second issue that's a problem with China is demographics. I don't have to go over charts that show weakness of demographics in China. You're very well aware of that, everybody is. But the reason this matters is because as household saving goes down, as demographics go down, as a country ages, its household saving goes down because all people don't save, they consume. People between 45 and 65 save as their incomes go higher. So as China ages, its saving rate will go down. However, China, given the slowdown in growth, doesn't have the luxury to drop its investment rate. You will have to keep investment rate high. What happens if your savings goes below your investment? You get a current account deficit. And that's what China is already flirting with. In 2018, its current account almost dipped into a deficit. China, in my view, over the next 5 years, will dip into a deficit on the current account. Why is this important? Again, most of the audience here is Latin American. You all know what happens if your current account is in deficit. You become addicted to foreign capital flows to balance your payments. And if those foreign capital flows disappear, you have a classic balance of payment crisis. China will experience such a crisis if it decides to be geopolitically aggressive. And that's why I don't think that China is going to be aggressive over the next 10 years. It's trapped by the geography and by Straits of Hormuz and its addiction to foreign sources of oil. It's going to be increasingly more addicted to foreign sources of demand and increasingly more addicted to foreign sources of capital. What does this mean? It means that if you're an investor, there are interesting investment opportunities in China. In particular, we like semiconductor companies and solar companies. Anything that has to do with the alternative energy, EVs, green technology. China is emphasizing that because it's its only way to become more independent. And semiconductor companies, obviously, that's also important for Aggregators. But a war between US and China, I wouldn't expect it. Now, I don't have much time for the last paradigm shift, which is fine. It's actually quite simple and obvious in terms of implications for investors in Latin America. It has to do with the race to zero, this concept that we are currently experiencing a real emphasis on green transformation across the world. Obviously, we had a summit in Scotland, didn't really go anywhere. But what's important is that policymakers across the political spectrum are starting to really focus on the green transformation. What I want to talk to you about is that this is irreversible. In my view, this is the #1 investment thesis for the next decade, more so than crypto, more so than metaverse, more so than anything else. The #1 investment thesis over the next decade is going to be the shift towards a green transformation. But it's happening not because Al Gore and Greta Thunberg told us it's happening. It's not happening because we actually care about the planet. It's happening for 3 reasons. First and foremost, the technologies that underpin the green transformation are here, and the transformation in technology is real. It's legitimate. Alternative energy, costs of alternative energy have collapsed in just 10 years. Cost of batteries have collapsed. The technological innovation follows Moore's law in alternative energies. So the first issue is that technologies are legitimate and they exist. The second issue is this macro policy, the policy of the Buenos Aires Consensus. What does that have to do with the green transformation? Well, if you're going to generate nominal GDP growth, you need to break a lot of windows, to use the Keynesian thesis. So the green transformation, the re-electrification of the planet, becomes a jobs program. And that's why if you look at the right-hand side, the global green initiatives pledged so far basically dwarf any other major project we've ever done as humans, including the US interstate highway system or the things like the Apollo program. Also the Great Wall of China, by the way, if you're interested, which is kind of hilarious, although my team did not find it funny when they were trying to inflation adjust the Great Wall of China costs of building. The bottom line is that the impetus to generate growth makes it easy for policymakers to commit to these green initiatives. The second issue is geopolitics. As I said, China is increasingly addicted to foreign sources of oil. It needs to find a way to set itself free of the Straits of Hormuz. Can invade the American Navy. It could do that. That doesn't seem like a wise thing to do. Instead, it is going to build up its EVs and batteries technology. Also, as China comes to dominate batteries and EVs, it creates an incentive for other countries, because of national security redundancy prerogative, to build up their own capacity. So there's a geopolitical component to the green transformation that makes it quite sustainable. What does this mean for investors? Very quickly, in terms of what it means for investors: 1, invest in mining; 2, invest in green stocks; 3, invest in industrials and energy over IT and communication; 4, do so in the private space in particular; and 5, productivity will rise over the long term. This will be disinflationary, but in the short term, as we're rewiring the whole planet, this will be inflationary. Finally, what does all of this mean for Latin America? Well, I think what all of this means for Latin America is that ultimately we are entering a commodity supercycle. And I think that that's a really good thing. Unlike the previous commodity supercycles, Latin American currencies are entering this commodity supercycle at very cheap valuations. If you look at, for example, Mexico's real broad effective exchange rate, you can see that Mexican peso is extremely cheap relative to both other EM exporters and relative, most importantly, to China, which is really important because from 2000 to 2012, Mexican peso was actually quite expensive. So not only are currencies in emerging markets cheap, especially in Latin America, but also so are the equities. If you can look at 12-month forward PE ratio, Latin America is by far the cheapest relative to emerging markets, global, and so on. And yet real GDP growth is on an upswing. So in my view, if you look at this chart on the right, this is a real investment opportunity, not just for you in Latin America. In fact, actually for you in Latin America, it may not be that interesting. But for the rest of us around the world, when we look at this chart, it means that something is going wrong. The market is basically ignoring what's happening to commodities, assuming that the Fed will somehow end the cycle prematurely, even if that brings up a civil war in the United States of America. Latin America versus EM Asia equities are extremely cheap. And I think that the performance of commodities will lead those assets higher. That's why we at Clock Tower actually created a specific fund for Latin America. It's focused on fintech, and we continue to think of ways to leverage ourselves to the region. Okay, so I'm 4 minutes over time, which I think is not bad given that I had 63 slides. So thank you so much, and I'm open to Q&A.
Thank you so much, Marco. Well, once you mentioned this very interesting thing about Paul Volcker, and to say that there is no way that an academic could do this by only being competent. And it was the medium border that was okay with this. So what do you think is the role for institutions, supranational institutions in the Buenos Aires consensus?
That's really putting me right on the spot there, Antonio. You know, I think central banks are independent in the short term. I think that's clear. But in the long term, we know that central banks don't really have independence. It never did. And that's because the appointments to the central banks are made by politicians. So over the course of 2 to 3 years, during a political mandate of a leader, they can use appointments to change kind of the trajectory of the central bank. And you know, this doesn't happen in populist countries. This happens in all countries. Think about Axel Weber, for example, who was, you know, supposed to be the next in line for the ECB. He met with Angela Merkel in 2011, I believe. And in this secret meeting, nobody knows what happened. But I assume that Angela Merkel asked Axel Weber if he was willing to buy Spanish and Italian debt. He probably said no. She said, okay, well, I'll find an Italian who will. And then he resigned from the Bundesbank the next day. So what is the role of you know, institutions? It's going to be kind of whatever the policymakers really want. And I mean by that, really politicians. I think what I don't want to do is I don't want to give you a should answer. I have no view on what should happen. I'm just giving you a sense of what will happen. Now, I think the audience right now might really disagree with me for good reason, and I hope you do. I hope that most of you disagree with me. But I think that over the longer period of time, it is just going to be very difficult to move against the political zeitgeist. And we obviously saw that with the Fed, with the average inflation targeting regime, with some of the statements that premature tightening in the past has caused undue pain for the median American, which is almost verbatim quote from Leo Brainard, who I think might succeed Jay Powell. So there's this more of an emphasis on different types of employment, different minorities in their employment. And I think that with these supply side issues driving inflation higher, I think it'll be easy to make an excuse for why inflation will be allowed to be higher. And here, I don't want to use the term should, but I will say that it's not crazy, it's not wrong, it's not insane to focus on the supply issues and the Capex requirements of this massive green transformation. It's not necessarily incorrect. It's not just an excuse that central banks will use to keep interest rates lower than they probably should.
Our following session will be about CBDC, and you mentioned a lot of things about the US dollar. And what lies ahead for the dollar as the dominant reserve currency? China wants to de-dollarize the Belt and Road Initiative. They are going to be the first launching a CBDC. So how do you think this could evolve?
Well, I would love to listen to the next session so that I can get the answer. I will just say this. I think that China being the first in adopting sort of a sovereign cryptocurrency is important. I think it will allow them to have some innovation in monetary policy. We all know that this will potentially allow central banks to get much more granular in the imposition of interest rate policy, for example. In fact, having multiple interest rates for multiple actors might be a possibility with the adoption of cryptocurrencies. But I think that the bigger question is, what is the alternative to the dollar? And for the most of the last decade, I've always said none. You know, for the past decade, I've been very skeptical of the view the dollar could kind of erode. But I actually think that the euro is rising. First of all, in terms of global payments, the euro is now caught up with the dollar. I don't know if you've seen the data on this, but it's actually very interesting. And I think one of the things that's happening that nobody's talking about is a break between Europe and the United States. It started with the Trump administration, but it recently has continued with the Biden administration. So the nuclear submarine deal that was scuttled for France by the United States is really, really significant. That was 2.5% of French GDP. The equivalent would be if France undermined a $567 billion deal for the United States of America. This is big money at play. And the United States basically chose not to incorporate any EU member state in its containment of China. Why is this important? Well, if you're running a country like India or Brazil or Mexico or Pakistan or Iran or Egypt or any other major economy that's kind of a third way, non-aligned, you're probably going to want to use the euro as a sovereign debt hedge and also as a payment system. Why? Because Europe is emerging as this third entity, not because of growth, mind you, not because of power, just because it hasn't collapsed, very low threshold. But that is allowing many actors, whether sovereign or private, to diversify their exposure to the US dollar.
One of the main takeaways of your framework for me has this, that politicians are price takers and not the price makers. So through these lenses, is there a risk that there could be an exception, like to this rule, like to suppress the medium voter, like for example Afghanistan or Cuba? What do you think about it?
Of course. My framework really is focused on the investment relevant world. And so the reason that we're interested from an investment perspective in economies is because they have something to offer. And that usually means that they're growing fast, that the middle class is rising in power, and that as such, it's very important for policymakers to kind of respond to the middle class. So while I think your examples are very correct, Venezuela, Cuba, Afghanistan, many other countries. Ultimately, policymakers try not to steer clear of the median voter. A good example that I talk about in the book is China. Does China have a median voter? Well, of course, it doesn't. I mean, there is no voting. But if you actually go back and look at every single policy that Xi Jinping has implemented since 2012, since coming to power, every single one of them was tested in the social media and was basically done to satisfy the rising middle class. Every single one. Anti-corruption reform, middle class wanted it. Anti-pollution, middle class wanted it. Anti-SOE policies, middle class wanted it. Lowering real estate prices, middle class wants it. Literally every single thing that Xi Jinping has done was basically focus group tested in social media and in various internet kind of chat rooms, if you will. So I think that that's a very important point. Policymakers always adopt policies that the median voter wants. The reason this is important for us as investors is that we overstate who wins elections. And this is, by the way, the case in Latin America more so than in any other region. And I'm not saying that Latin American investors themselves make this mistake, although I think they do. But I would say that we in the West and in the rest of the world even emphasize who gets elected in Latin America more. But if you actually see performance in Latin American assets, it really doesn't matter. What matters is whether you're pre or post current account balance of payment crisis. That's the only thing matters. So Karl Marx himself could rise from the grave, become president of Brazil. But if the currency is cheap, if the current account is in a surplus, and if commodities are going higher, Brazilian assets will outperform.
Now, I get a question from the audience, and it says, doomsayers write off the United States going forward, and inevitably the ascent of China substituting the US as the dominant power. What would you say to this?
No, I think China is at peak power. I would actually say that if China wanted to militarily reunify with its wayward province of Taiwan, it could have done it easier in 2011, when it was less addicted to Taiwan, to foreign oil, when it was far more capable from a domestic consumption perspective to ramp up its consumption domestically. So I don't think that China is really a major threat to US power, but it doesn't mean that US is at the same level of power relative to the rest of the world that it was 10 or 20 years ago. In other words, in relative terms, US power is either flat or coming down. But the biggest risk, I think, to the US is not really challenged from Russia or China. The biggest risk is what I talked about, which is this income inequality and political risks domestically. That can cause an overly populist response, and that can erode the power of the dollar, and that can erode the efficiency of the US economy. So I would argue that the biggest risks to the US are domestic, not foreign.
It's funny that you mentioned Marx, and as I recall from my high school reading of Karl Marx, yes, reading Marx in high school, that was a thing in Bolivia, where I am from 20 years ago. When the means of production conflict with the mode of production is when you got this revolution. Is that revolution this race to zero? How do you see this?
Yeah, that's a great way to put it. I mean, that's exactly how I put it in my research. I didn't really go over this, but there was a slide that I skipped over that talks about that I see this in the Marxist terms of means of production being changed. And I think that we're moving away from industrial scale means of production. For the last 400 years, Antonio, I see the means of production as those that allowed us to scale everything. You know, men with guns. We scaled humans who can read. We scaled medicine. We scaled iron. We scaled railroad production. Everything was increased. I think going forward, the means of production are changing. They're allowing us to produce goods and services for the tail of distribution, not for the median. And I do think that this will cause a lot of dislocation. And I think it will cause, both political risks and also great opportunities for human race. Like, I do think we will eventually solve climate change as a problem because of this technological innovation, but it will be pretty turbulent. In the near term, what is the main risk to me? I think the main risk to me is just that we're rewiring the whole planet. That's going to be expensive. That's going to cause a lot of commodities to go through the roof. And you saw the yellow vest protests in France, for example, which was sparked by an increase in gasoline prices. You saw what happened in Chile with a very, very minor increase in metro costs. Obviously, there were other issues that underpinned that protest. But I think that we can see that the cost of this transformation is going to cause a lot of people to lose faith in institutions and policymakers.
I know that you're a basketball fanatic, and sport analytics have changed the game. Social media has accelerated investment narratives. How do you navigate this without freaking out with a few tweets? You mentioned that you have to avoid being a human of getting this right. Do you think machine learning, AI tools, that algorithms encourage us to polarize, to read only the things that we want to read? How do you think in terms of incorporating this through your framework?
Wow, there's a lot of different questions in one. I like that. Here's what I would say. First of all, going back to your first comment, which I cannot just let slide, I am a huge basketball fan. And what I will say is that it's a really good example of how overly using AI and machine learning is a problem. For those of you who are basketball fans, and I'm sure there are some of you, one of the trends in NBA is an emphasis on three-pointers and layups. No more mid-range jumpers. Why? They're inefficient mathematically. The problem with this that in a playoff game, that's the only part of the court that's open, And so teams that retain the ability to hit a mid-range jumper suddenly have an emphasis when it comes time to winning. In other words, the problem with AI and algorithms and machine learning and all this stuff is that it's only looking at a limited data set. And it doesn't necessarily tell you what's true innovation. Like Henry Ford famously said, if I had asked the customer what they want, they would have said a faster horse. In other words, if you're using incredible AI and incredible quantitative tools to gauge insights from a particular data set, the positives, the usefulness of those conclusions will be only as useful as the quality of the data set, which may be limited. And that's what is example with Twitter and social media. Yes, it's becoming more polarized, but what I would say is that what's becoming more polarized are people who use media and social media intently. And a large proportion of votes don't. A large proportion of voters don't actually sit on Twitter all day. As my favorite comic Dave Chappelle said, Twitter ain't real life. He added something else, an F-bomb too. But the point is, Twitter is not real life. It's not. That's how Joe Biden wins the 2019 nomination, the 2020 nomination, and the election. Every single political analyst that I spoke with ahead of the 2020 election told me that I was absolutely crazy to think that Joe Biden would win. But two very important constituencies of the Democratic Party, the African-American voters and baby boomers who are elderly, were not on Twitter talking about Bernie Sanders or talking about Elizabeth Warren and so on. So that's, I think, something that investors should also think about as well. The more we use systematic strategies and quantitative tools, the more we're liable to actually face incredible downside risks in times of volatility and turbulence.
Well, anything on your brain right now that you think we didn't cover?
Yeah, I think that, we kind of hinted at it, Antonio. You asked me what are the biggest risks to, this green transformation. I think price increases are going to be a problem, but they're not going to be a problem for the American consumer. You hear a lot of investors out there talking about how the Fed is going to have to increase rates because inflation is going up in America. Like, wait a minute. Food and energy is a very small component of the CPI. Like, nobody in America is going to go to the streets to protest food prices going up. That's just that's not the world that's going to happen. In fact, the tight labor market will ensure that wage prices go higher as well, which will keep people happy for the next 2 to 3 years as inflation outperforms. In the long term, I agree. Obviously, there'll be some angst. Specifically, real estate prices are a big political issue in the US as they are in many other places. But look at Canada. Canada should have had 17 revolutions by now gauging by the real estate prices. So what worries me, Antonio, is not angst in the developed world. What worries me is the angst in the emerging market world. Particularly India seems as a really interesting country. It's outperformed massively this year. Some of the structural reforms that I've been worried that would never pass, they actually did pass, and it's outperformed the emerging markets considerably. But that's happening in a context where commodity prices are going high, which usually is not good for the Indian economy. And so I worry that the CPI increase in countries where food and energy are a high proportion of the basket, that's where the political risks are going to appear over the next 1 or 2 years.
Marco, what a treat to have this conversation. I hope that we can meet in person next year in Colombia, here in Cartagena. Thank you very much.
I would love that. Thank you so much. Thank you, Antonio.
Thank you.
Amarillito, ¿lo viste? Amarillito.
Como un turpialito, pero...
Iker.
Hola,
Iker.
José Manuel, ¿cómo
¿Qué
estás?
tal estás? Muy bien. Hola, Antonio.
¿Qué tal, José Manuel?
Fantástica sesión, la de Marco.
Cuento impresionante.
Estáis haciendo un encuentro maravilloso,
Estamos divirtiéndonos de lo lindo.
Vamos, es espectacular. A ver si Iswar se conecta pronto, porque decía que estaba en el Parlamento británico.
Tenemos un tema con el audio.
¿Me oís bien?
No, te oímos bien. Es para producción. Se está filtrando al canal. Marcos.
Tal vez yo tenía un pajarito aquí.
Ah.
Hola, buenas tardes, soy Daniel.
Hola, Daniel. Creo que
Este evento contará con una plataforma dedicada a la transmisión en vivo. Entrando a la página web del evento, eventos.flar.net, podrá encontrar los auditorios de las sesiones en vivo. Una vez en el auditorio, podrá ver la sesión en vivo, participar en el chat y ver información de la sesión, así como la biografía de los conferencistas. Si tiene dudas sobre la usabilidad de la plataforma, puede escribir un correo a comunicaciones@flar.net.
Antonio.
Welcome back. You may have noticed by now how all the sessions on the agenda we have prepared for you this year are linked. Mauro Guillén discusses 2030 demographics is linked with Robert Posen and the future of work. The second session, in which Kay Marvel discusses climate change, links to my conversation right now with Marco Papic about the race to zero and its geopolitical implication. The session with Cam Harvey on Web 3.0 or DeFi or decentralized finance, which has already received over 120K views on social media, is closely related to this session, in which we will explore the future of money in depth. We are delighted to have long-term collaborators with our events and institutions on board for this. Let me begin with the first, Jose Manuel Marquez, head of the Bank of Spain Financial Innovation Division, who is directly involved in projects about system design and CBDC interoperability. Thank you very much, Jose Manuel. Our virtual stage is all yours.
Thanks a lot, Antonio. Thanks a lot, Iker, for organizing this wonderful conference. Today, I had the pleasure to talk with Professor Iswar Prasad. Iswar is the Tola Nippers Senior Professor of Trade Policy at Cornell University. He's also Senior Fellow at the Brookings Institution, where he holds the New Century Chair in International Economics and Research Associate at the MBA. He was previously Chief of the Financial Studies Division in the IMF, and also head of the IMF in China, in the China division. On top of that, he has written in several top journals, including one paper some years ago for the FLAR about the CBDC on Latin America. And he recently published a must-read book. It's a fascinating book that covers many aspects of what is happening in financial innovation and the financial system, with a title with the future of money. Iswar, thanks to be here and thanks for the opportunity to talk with you. Iswar, in your book, you revise in a very periodical way. It's clear your passion for teaching a broad set of issues, including fintech, insurtech, cryptocurrencies, CBDC, the role of central banks, or even the change in the international monetary system. I think it will be impossible to cover all these things. Then, in less than 1 hour, then I would like to focus mainly on crypto and on the CBDC. But before that, I would like to enter in some broad question. Innovation for financial system, as you mentioned in your book, is not something completely new. That is, we have several innovations in the history. We have the deposit insurance, the credit card, the ATM, the risk models, the online banks. But there has been a set of several innovations in the financial system. Then the classical question is why this time is different? Paraphrasing Reinhard Rogoff, why we should think that now we are facing a different change, a different innovation for financial system?
So thank you, Jose Manuel, for that question and for introducing me. And I'm also very grateful to FLAR for allowing me to participate in this conference. And the FLAR annual conferences are always one of the highlights of the policy conference calendar, given the range of issues that are discussed and the quality of the participants. As you correctly point out, Jose Manuel, financial innovation is nothing new. And while the term fintech, which is supposed to encapsulate this notion of new financial technologies, suggests that something has really changed this time. It's worth thinking about what is really different this time. In my view, there is one important difference, which is that we now have the ability to create transformational change in many aspects of financial markets and institutions, thanks largely to a set of new technologies that have put the power of these technologies at the hands of consumers and businesses in a way that they have not been able to access them before. And of course, even before one talks about cryptocurrencies and blockchain technology, there is the sense that mobile technologies really have made a big difference in the ability not only to create innovations that can reach even the common man very easily, but to allow them to be scaled up to a level whereby they can provide very broad access to even basic banking products and services, irrespective of whether you're talking about a developing economy context or an advanced economy context, and in a way that more directly conducts financial intermediation operations, say connecting savers and borrowers directly through fintech lending platforms, providing easy access to low-cost digital payments, which until now was reserved for the relatively well-off and largely limited to advanced economies. This brings up another important issue about the new financial innovations, which is that emerging markets do seem to be leapfrogging advanced economies to a significant extent. And part of the reason for that is related to the scalability of these technologies, but also the fact that you have a rising middle class in these economies that wants better products and services, and the fact that you had a regulatory void that allowed these new products and services to be brought up. So I think we are really at the cusp of something quite transformational right now.
Thanks, Israel. I think that this connects very clearly with the last session that we have about the geopolitics and the emerging of the middle class and the Latin American and all these opportunities. Let apart this change in the international financial system and the roles of emerging for later, and entering a bit on the discussion about crypto assets or crypto tokens or cryptocurrencies. You mentioned in your book that paradoxically that Bitcoin and was really a smart idea. You explain very clearly the nice and the wonderful proposition of Bitcoin and how it solved this reliance on third parties. However, even that is a smart idea, clearly failed and did not succeed as a means of payment. Let apart what happened in El Salvador. But instead is gaining support as an investment or a store of value. And this is basically, as you clearly point out, that because of the scarcity of the issuance of Bitcoin and the demands from the people of this asset. Let's begin with this one. Could we consider crypto asset like Bitcoin or Ethereum, not including the stablecoin, that is something different, as a traditional investment asset, that is something with maybe not an intrinsic value, but high volatility? But there is something different, especially in crypto, in this Bitcoin or Ethereum, that we should take into account from an investor perspective. And please take into account that most of our audience are reserve managers from central bank, and I think that they are really interested in your asset.
Yeah, that is a very profound question that becomes especially important when you're thinking about a market that now has a capitalization approaching $3 trillion by some measures. It is paradoxical, as you've pointed out, Jose Manuel, that what was meant to be a pseudonymous medium of exchange that did not require a trusted third party such as a central bank or a financial institution has become a speculative financial asset. So as an economist, I think the question to ask is, what is the demand for this asset coming from? Is it providing any intrinsic service? Does it have any intrinsic value? And the answer to that seems to be no, because Bitcoin has failed in the fundamental objective for which it was set up. So then one can think about what the alternative sources of value might be. And again, as you pointed out, the notion that there will be only 21 million Bitcoins ever created, of which about 18.5 million have been created so far, is the fundamental value proposition. But as an economist, this seems like a very dubious value proposition, that something that is scarce simply because of its scarcity is going to have value. Now, certainly one can make the point that the same seems to hold true for gold, which has at least some basic intrinsic uses, but certainly has a market value that is far out of line with its intrinsic value. And it's often spoken about that Bitcoin can serve as an inflation hedge and is a better source of value in terms of the long term compared to something like a fiat currency that can be issued at will by central banks. But in my book, I lay out this proposition that, in fact, what makes central bank money a much more viable long-term store of value is not that it is restricted in supply, but precisely because it can be supplied elastically, that is essentially in infinite quantities. Because if you think about what modern financial systems need, they need liquidity. And often they need very large infusions of liquidity in order to be able to sustain themselves through periods that are very difficult in financial terms. And what the major central bank currencies offer, of course, is precisely that, the ability to be provided in very large quantities when you have substantial demand for liquidity. So again, perhaps one might think about this as paradoxical, but it is the very elasticity of supply in the major fiat currencies that preserves their stores as their roles as stores of value. So ultimately, as I look at this over the longer term, it's difficult for me to envision Bitcoin. Once you set aside the very cool technology, and the technology, as you've noted, is certainly very cool, and the fact of scarcity, it's difficult to see where exactly the value comes from, except, of course, investors' faith. When you have a large enough community of retail investors and potentially wholesale investors as well, who are willing to put their faith behind this scarce commodity, maybe it has value. But I worry about whether this is going to be value that is a sustained proposition over the long run, especially relative to the traditional store of value, which is fiat currencies.
Yeah, it's something logical. That it is, you think Bitcoin has been designed as a means of payments, and basically maybe this lack of supply is because it's designed as a means of payment, but now suddenly it's a store of values. And some research analysis with some econometrician models that we performed, the Bank of Spain, point out that the fundamentals what explain the price of Bitcoin, it's constantly changes around time. Then it's something very unstable from an investor perspective to know how to invest or how should this change. Then I agree with your concern that this is very, very unstable what is happening with Bitcoin, and it's only the faith of people that basically explain the price. But let me jump to another issue. That is, I usually talk with many people from the crypto space. I had to manage the sandbox and this kind of discussion with innovators. And usually the people from the crypto space claim, okay, I would love to be regulated. I would love some kind of regulation. I think that very soon we are going to see if this is real or not, because as you know, in Europe, we are close to finalizing regulation on crypto, on service providers on crypto assets and on some of the issues. And there has been some rules from the FSB also regarding the crypto space. But even though we have some regulation, there are some aspects, and Bitcoin is one example, that are based on a purely decentralized mode, or some innovation, like for example, DeFi, that is very difficult to regulate. Then my concern is, could we enter in a space where we could have a clearly regulated financial system, a clearly less regulated financial system, like the Wild West financial system? Should this be a concern to have these separated worlds? How we can manage this situation? We should deal with more education, with more discussion about what will imply to be regulated, what will imply not to be regulated, or the approach should be like China of prohibition on these kind of things that are impossible to regulate, or some kind of standardization like India. What is your opinion on this situation?
That is a very profound question, Jose Manuel, and one that national regulators in every country are going to have to deal with because, Bitcoin and many of the financial products spawned under the label of DeFi know no borders. You can even think about payment systems, both at the retail and international levels, essentially being intermediated through some of these platforms. So you certainly need regulation. But at the same time, the question is how one can make sure that one can benefit from the potential innovations that can be had from democratizing finance and making a broad range of products and services more easily accessible to a large part of the population without killing off the innovation. At the outset, I would note one irony, which is, as you correctly pointed out, Jose Manuel, the cryptocurrency industry does seem to be welcoming regulation, but up to a point. I think the fact that you have the government providing some degree of regulation actually legitimizes the industry, and the industry certainly benefits a great deal from the perception that they are, so to speak, officially approved, even though that's not quite the intent of the regulators. Of course, once the regulations actually start taking firm shape, you will no doubt hear a lot of squealing from the cryptocurrency industry that the government is trying to block innovation. So that is coming. But I think the risks are real. And from a regulatory point of view, I think both the institution or product-specific risks and the systemic risks will need to be carefully thought through. At the moment, if you think about the capitalization of the cryptocurrency market, which is in the range of $2.5 to $3 trillion, depending on which minute you happen to look at the data, the reality is that you don't have that much exposure of the major financial institutions, as so far as most of us are aware, that could cause a huge amount of spillovers to the broader financial system. But certainly there are lots of naive retail investors who are joining the party quite late, as I see it. So issues of digital access, financial literacy are certainly going to be important ones. In the specific context of DeFi, of course, there is a notion that you can actually use computer tools to test the security of these products and also about the financial risks associated with these products. There is the notion that you can use permissionless composability to plug in not just different modules to create new financial products, but also plug in regulatory and compliance tools. But I think there are some other risks out there. I had an op-ed in the Financial Times just a couple of weeks ago pointing out that there are new and potentially unforeseen risks that are coming. As you plug together multiple products, then you end up with a situation where you increase the attack surface. And while the blockchain is certainly very secure and provides a great deal of resiliency, there is a real concern that you could have sophisticated hackers basically exploiting loopholes, especially as you plug together a variety of products. There are, of course, technological vulnerabilities out there, but even the decentralized nature of the governance, I think, creates some risks. Now, the notion of not having governance centralized in an institution or the government is certainly a very attractive proposition. But some of my colleagues at Cornell did this very interesting study where they found that there was a possibility of front-running a particular product, a particular DeFi product. Now, they had nobody to report this to, so they wrote a blog post pointing out this potential vulnerability. And what happened before the community could fix the open source code to fix this problem, a whole cottage industry of bots emerged in order to exploit this precise vulnerability. So I think while the notion of decentralized governance, decentralized architectures are very attractive, we're going to have to be very cautious about the risks that may emanate that are new. So ultimately, governments are going to have to play a big role here. Even when you think about something like stable coins, which are supposed to be relatively safe because after all, in principle, they are backed up by reserves of hard currencies and reserves of liquid instruments in those hard currencies. There is a concern, and there is a lot of discussion here in Washington about this right now, that these may end up becoming exactly like money market mutual funds, which were supposed to be very safe investments, but in the lead up to the global financial crisis, turned out to have a variety of problems because the markets for the assets that they held turned out not to be as liquid as we thought they were. So we might end up in a situation where you essentially have stable coins becoming like unregulated money market mutual funds. But at the same time, stable coins are trying to meet a real need for easy access to low-cost digital payments. So I think governments are going to have to find a balance here. I think banning cryptocurrencies altogether, like China has done, may not be the right answer. Perhaps the India approach of providing a payments infrastructure on top of which the private sector can innovate and build new products, that might be the enlightened and right way to go.
Very interesting that your answer touched many aspects. That is, I will take several issues like the regulators should adapt to this new technological system and engage also and take into account that it can be useful to impose under the compliance, but at the same time, be aware of this new financial instability, new financial vulnerability that came from these decentralized instruments and these new technologies, and maybe the too big to fail or the systematic failures for the systems could be others, and then we should also invest in cybersecurity and all these kind of issues. And let me jump to this debate that you open now with stablecoin. I agree with you that there is a big concern, and you know that in Europe we are also close to develop some kind of regulation, and we have an intense discussion about how to regulate and what should be the regime for stable coins. I know that in the United States, in US, you have some proposals, for example, from USD Coin that recently announced the intention to ask for a full reserve bank license. Something that remind me that is very close to the traditional concept of narrow banking. But my question will focus on the last part of your answer. They are covering some business area or some aspect that clearly has some sense. Then, what do you think is the main value added from this stable coins proposal? Why these companies proposing some stable coin will like to enter? Because here the proposal is more related with payment system and not with investment side. Why they will like to enter in the case of developed countries, in the case of an already very growth space like the payment system? What are they adding to the system?
That's a good question, and it is very country specific. If you think about a country like Sweden, there is no user case for a stable coin because the private sector is providing very widely accessible, very low cost and efficient digital payments. And a stable coin probably wouldn't get traction. If you take an economy like the US or even Canada, for instance, you have the existing payment providers, including credit card companies, still having a very strong foothold in these economies. You know, I can use Apple Pay on my phone, but I have to connect it to a credit card or a bank account. And the reality is that in the US, about 5% of the adult population is still unbanked or underbanked. If we look at the availability of credit cards, it is quite limited. The same is true of Latin America. I did some work with Flour, pointing out that in many countries in Latin America, the adoption of digital payments is again quite limited. Of course, people prefer cash, perhaps because it allows them to avoid taxes and you have a large informal economy, but you also don't have easy access to digital payments. So stable coins, in terms of retail payments that are easily usable by both consumers and businesses, might really have a user case going for them. The same is true of international payments, which are particularly beset by lots of inefficiencies in terms of cost, the time to process payments, the time it takes for finality of settlement, the fact that you cannot easily track payments in real time. Given the technologies that are available to us these days, it is astonishing that we don't have better payment systems. So I think stable coins can certainly give us more effective ways of using even retail central bank money and perhaps also get around some of these inefficiencies at the international level. So in the US, I think there is potentially a case to be made, but I think one can ask as a government whether you really need stable coins to be able to accomplish all of this. The US has an initiative being undertaken by the Fed and other government agencies to improve both the retail and wholesale payment systems. Although, if you look at some of those proposals, it looks like the US is trying to get in the next 3 to 5 years to where China was a few years ago. So some advanced countries, some developing economies are certainly far behind. And in those countries, maybe stable coins can play a useful role. But there are some significant concerns here. I mean, stablecoin issuers, including Facebook, which of course is now called Meta, when it talks about its proposed stablecoin Diem, talks about it not trying to run monetary policy in any way, because after all, every unit of Diem will be backed up by reserves of whatever hard currencies it is issued against. But given the very widespread reach of Facebook, given the enormous financial clout it has, it's not inconceivable that one day Facebook, once its stablecoin is widely accepted around the world, and particularly in developing countries, decides to start creating money of its own without backing by fiat currencies. So I think regulators also need to think a little bit about what sort of foundation might be created for private corporations beginning to issue their own monies in competition with central bank monies.
Yeah, let me develop more on this discussion, because I think that next years, I think that the next 2 years, we are going to have at least the basic rules or the basic regulation for stable coins. I think that Facebook has been very clever in order to promote it, that all the regulators are discussing how to regulate this new product, and in a record of time, we are going to have some kind of regulation. Then once that we have some kind of regulation for stable coins, things could dramatically change, as you basically pointed out. Then I think that we have, from my perspective, we have two concerns. One concern is the one that you mentioned, that given the network effect that they will have some monopoly power in the payment system, or even in the issuance of money in some developing countries. And in some sense, we have the experience of China, where basically two big tech companies have the monopoly of the payment system, and this explains the reversion from the People's Bank of China with the CBDC. And the other concern is the opposite situation, where you will have several payment systems that could not be completely interoperable, and that maybe you will have a very fragmented payment system. That is something not necessarily very good for the financial system. Then how do you see these two concerns? Because it's really difficult to avoid these two extreme situations.
You're right, Jose Manuel. I think you've pointed to some difficult tensions that regulators will have to face. Now, again, as economists, we are all for competition. I think the idea of letting 1,000 flowers bloom, having multiple payment providers compete certainly makes a lot of sense. But if you leave a regulatory void like China did, you could end up, as you correctly pointed out, with a duopoly where Alipay and WeChat Pay dominate the payment systems, make it very difficult for new entrants to join the payment space. And of course, as the Chinese government has become very concerned, they control vast amounts of data and are not under clear regulation about how the data are collected and how they are used. There is an intermediate way that I think might prove to be a solution to these different tensions, and that is the India stack approach. What India is doing, I think, is very sensible in terms of providing the payments infrastructure, the unified payments infrastructure, which is basically a government-run payment system that acts as the back end on top of which private payment providers can innovate. So even though you may have a lot of fragmentation in terms of the payment providers, you do have the interoperability assured by the fact that the government is providing the back-end payment services. So now you have a level playing field where, in fact, existing payment providers as well as new payment providers will have easy access to this payment system and can make sure that the different payment systems talk to each other. So you have competition and you have the private sector basically doing all the payments innovation at the front end, but at the back end, you have the government providing the right kind of infrastructure. But there is a very important additional set of rails that the government has provided that are important in terms of these broader objectives. The first, of course, is the identity rail through the biometric identification scheme, which has given practically every person in India easy access to a digital form of identity, whether you're in a rural area, whether you're illiterate, and so on. And that biometric identification is really important, and it's also created the architecture or the infrastructure to be able to conduct certain government policies, such as cash transfers rather than subsidies of various sorts. That is, we know, quite distortionary. So the cash transfers can now be linked to bank accounts that in turn are linked to those with those biometric identities. But the other part that is equally important is the government is setting up data aggregators. Now, the legislation is not through yet, but the idea is that these data aggregators would basically suck up the data that are collected by different payment platforms, and they would be the ones under the government's regulation who let the owners of the data, which is, of course, the consumers themselves, decide what is done with the data, who gets to see the data, and what sort of regulations control the use of that data. And that is going to be a very important consideration for all of our economies, because ultimately one thing that is coming out of the new financial ecosystem as it moves towards a more digital form in all aspects is going to be a lot more data that is available. And making sure that this data are really in the hands of the consumers in terms of how they are used is going to be really crucial. So I think the tensions you pointed out are ones that every country is going to have to deal with. But I think there are ways to find a middle path that allows you to create the ground for private sector innovation without the government being too intrusive, except in areas where it really needs to exert a somewhat heavier hand and not leave things to the private sector.
I agree with you. That is, I think that the India experience is very smart, and they are clearly pointed out these three rails that you mentioned: the one on payments, the other one with digital identity, and the other one with data. But I think that in other jurisdictions, we are beginning to see a very similar approach. That is, you take from my perspective in Europe, in some sense, the CBDC discussion is looking to play this role of the payment rails that you mentioned. And this is also together with all this discussion on the open data space, all this discussion on the digital identity in Europe. That is, you think of it in some sense, in several jurisdictions, things are emerging in this way. That this is not only the proposition from the CBDC that we are going to enter now in the discussion, but it's also these other things that complement the system. That my point on that, and I think that is very close to your discussion, is that it's not only the CBDC the answer to what is happening, because this is a global phenomena that reaches several aspects. Some of them are purely in the financial system, but some other, like data or digital identity, are outside the financial system. Then in some sense, the financial regulators should talk with the other authorities also. Then do you see that this kind of coordination is becoming increasingly important, and that the authorities is taking this into account?
It's important. Whether it's happening is not entirely obvious, because regulators do tend to be quite siloed in many countries, and I think regulators are trying to deal with an important issue, which is whether they should tweak existing regulations to encompass the new products and technologies, or think about rewriting regulations in a way that makes them much more expansive and, in a way, much more flexible, in a way that they can be adapted to new technologies. But you're right, Jose Manuel, many of these conversations are not just about economic or technocratic issues. We're going to have these discussions at the societal level. If you think about CBDCs and how they might eventually displace cash, giving us no access to an anonymous method of payment anymore. We don't need to talk about this is a societal level, whether we're comfortable moving to a world where we completely lack access to an anonymous means of payment, and every transaction, like me buying you a cup of coffee, is going to be visible either to a digital payments provider in the private sector or to a central bank in the form of a CBDC account.
Yeah, let me go now to the CBDC. But before jumping to the CBDC, I know that I should ask you one question, and is regarding the El Salvador experience. My question is going to be based on what that is. I understand that part of the justification of recognizing the legal tender status of Bitcoin in El Salvador has been related with what you mentioned, that is the cost of remittances, the cost of cross-border payments. But my question is, why do you think the authorities use Bitcoin as the legal tender proposal, and not use other alternatives like some stable coins that will have less volatility and also will be easier to with these proposals to manage issues like AML or CFT and requirements. That is, why do you think these countries choosing specifically Bitcoin and not these other crypto alternatives more stable and more safety?
So our colleagues at FLAR know El Salvador much better than I do, but looking at it from the outside, it certainly seems a desperate measure by a desperate government to make up for its failings. Ecuador has been a dollarized economy for a long time, and that certainly is not politically convenient for Ecuador's leaders because it puts a lot of constraints on their policies, and Ecuador certainly has a lot of issues with fiscal mismanagement as well. So I think the notion of using something like Bitcoin to fix a lot of Ecuador's fundamental problems in terms of easy access to the international financial system, getting around US financial sanctions, and perhaps even riding the Bitcoin wave, buying a lot of Bitcoin and maybe easing up the government finances if the value of Bitcoin were to rise very sharply. I think those are all attractive ideas for a government like El Salvador, but frankly, I don't think this is the path to successful outcomes in any of these areas. As we've been discussing, Bitcoin, even if you think about the particular form in which they're using it in El Salvador, which is not literally Bitcoin, but a version of a token related to Bitcoin, that's not going to be very efficient as a payment mechanism, especially at the retail level. And I don't think it's going to accomplish these broader objectives that the El Salvador government really wants. So I think El Salvador should really focus on getting its house in order in terms of its domestic policies before resorting to a measure like this.
Absolutely, I agree with you. Yeah, just because we have like 20 minutes and we are going to run short of time. Jump to the CBDC, that is one of the hot topics on this payment discussion. I'm going to take the privilege of being the moderator, the one that asks, and I'm going to translate you the typical question that I always have to face in most of the forums, and is that is at least in the developed economies, that is, we already have a very efficient payment. We have a lot of things. We can do most of our transactions are not very expensive, at least the domestic one. Then why you think we need a CBDC? What we could have with a CBDC that is not possible to do today?
So actually, just before this session, Jose Manuel, I was giving evidence before a House of Lords Economic Affairs Committee, and this was certainly the key question at hand.
Yeah.
Unlike in the US and Canada, where the private payment systems are still quite inefficient and costly, so interchange fees on credit card payments, for instance, can range up to 5%. Britain has a fairly efficient digital payment system. So as one looks around the world for CBDCs, there seem to be a few motivations at play. One motivation in countries where there isn't easy access to a digital payment system or broad financial inclusion, a CBDC can provide a path to financial inclusion. The Bahamas, which has just introduced the first nationwide CBDC, the sand dollar, views this as a primary objective, and many other developing countries do. In a country like Sweden, where the private sector provides digital payments very effectively, the idea is to provide a backstop to the private payments infrastructure. In other words, the private sector does its job very well, but in a time of technological or financial confidence vulnerability, you want to have the central bank providing an alternative payment system that is always there for everybody to use, even if the confidence in the private sector payment system fails. And third, you can think about, as in the case of China, a CBDC, as basically providing a platform on which new payment providers can innovate. So the Chinese CBDC, the digital yuan, is essentially meant to keep central bank money relevant at the retail level. Now, we can argue about whether that is a worthwhile objective or not, but certainly the People's Bank of China seems to view it as important in making sure that the entire payment space is not dominated by the two payment providers. But this is going to be a case-by-case issue, country by country, to think about what objectives a CBDC can really fulfill. And in a country like China and or India, one might argue that the user case is actually much weaker than in many other developing countries. So it's really going to be a case-by-case, country-by-country analysis.
I agree with you that yes, the arguments behind each countries could be very different, but in some sense, the experience of China shows us that it is very important to be prepared in the case of big tech, of other companies develop alternative payment system. What you point is very important, that is to be able to have a platform of interoperability between the payment system. Then in some sense, this is a good lesson for most of the countries that basically are working on the CBDC in order to be prepared in case stable coins or other proposals will be developed and to be able to be useful as an interoperability link between several payment systems. Let me put on the table other question, other typical question, and it's the one related with, I have from the audience several questions on that, and this is related about the implications for financial stability. As you know, that is CBDC is basically a liability from the central bank. This could imply some changes in the funding of the banks, and some changes also in the connection in the reliance of the banks with the customers. Then what implications could have this for the financial stability, for the business model of the banks? Should this be a concern of how to introduce the CBDC? What will be the implication for the credit availability?
That's a crucial set of questions, and it's certainly one of the risks of a CBDC, especially if a CBDC takes the form of a digital wallet that is a central bank account. You face potential risks of disintermediation of the banking system because you might think about a central bank account as being safer than a commercial bank account, even if there is a deposit insurance system in place. And then especially in a time of financial panic, you might have a wholesale flight of deposits from the banking system into the central bank digital currency accounts. And that could precipitate the very financial instability that you're trying to avoid. I think there are ways that you can design a CBDC to fix some of these problems. The Bahamas, which I referred to earlier, provides a very simple answer to the question of how do you prevent flight of deposits or complete disintermediation of the banking system, which is that you put a cap on the amount of balances that can be held by consumers or businesses. The balance is slightly higher for businesses in CBDC accounts. The existing or the evolving design that we're beginning to see in countries like China and Sweden, which are undertaking CBDC experiments, also points to a way forward to keeping commercial banks relevant. So in these countries, we are moving towards a dual layer architecture where essentially the central bank provides its liability in the form of what are essentially digital tokens, but the digital wallets are actually maintained by the commercial banks. So these would be non-interest bearing CBDC digital wallets in parallel with their deposit bearing interest accounts. So in this case, the commercial banks and other payment providers can use the CBDC to innovate in terms of payments, as we were discussing earlier, but the commercial banks remain important in terms of maintaining know your customer requirements and so on. So I think there are ways in which some of the risks of disintermediation of commercial banks can be maintained, because nobody, I think, including you central bankers yourself, really want to be in the position of taking a large amount of deposits from the public and having to be in the position of allocating credit in the economy. And certainly, given that in most modern economies, commercial banks create most money as we know it. If you think about an aggregate like M2 rather than central bank money, we certainly don't want to do anything to affect commercial banks in such a drastic way. But having said that, commercial banks do face very significant threats to their business models from new technologies, from new fintech lending platforms, and so on. So changes coming on that front. But I think the CBDC risk to the banking system can be mitigated.
Yeah, I agree with you. That I think that there is a consensus on these two layers scheme. That is that you have to rely on the private sector in order to distribute these wallets. This is something that, from my perspective, is clear. But where this is not so clear is who should be the one that distributes this wallet. That is because at least in the Europe debate, we clearly identified that this should be regulated entities. That is something almost clear in every jurisdiction. But these regulated institutions could include the banking system, obviously, but also, for example, electronic money providers that some of the big techs already have this license of electronic money providers. Then it's not clear who is going to be the distributor, and this the customer relations will enter more competition from this big tech. With the CBDC, just two issues that you touched on your book that are very interesting. The first one is related with this the implication for cross-border dollarization that you mentioned, that one of the risks of the CBDC that will become easier for individuals to choose which currency they will prefer to use. And this could create, for some small countries, the risk of dollarization or euroization. And in some sense, this for me, this is a bit counterintuitive, because with the CBDC, it will also, for example, to implement capital control, because it's something that you can program it in the CBDC and avoid, for example, that this could not be spent in other jurisdictions. But taking into account this one, do you see any role of organizations like the IMF in order to have a more proactive role to coordinate all these initiatives in order to avoid sudden change in the currency management?
It's going to become a big issue. I mean, if you can even think about, basic payment systems as potentially posing risks to financial regulation, you could very well envision a situation where the entire retail payments infrastructure in a country is managed by a payment provider who sits outside your regulatory jurisdiction. Because again, if you're using stable coins provided by international stablecoin providers, or even digital payments provided by, say, Alipay or WeChat Pay, you could have access to these sitting in basically any country, and it's very easy to access those digital payment systems. And adding on top of that, the easy availability of CBDCs across borders creates another level of issues. Now, at one level, there are certainly many benefits to having more conduits to international payments. Certainly, it's going to bring down costs. It's going to make things much quicker. It's going to make it easier to track payments in real time. This is going to be good for cross-border trade. It's going to be good for economic migrants sending remittances back to their home countries. But all of these also mean that you're going to have many more conduits for capital to flow across national borders, which is going to make it much harder for countries that are trying to manage capital flows, manage exchange rates, and of course, emerging market economies and developing economies more broadly that are very affected already by capital flow volatility and the associated exchange rate volatility are going to face even more of a challenge. And I think there is going to be an existential challenge that many countries face, both in terms of their currencies as well as their central banks. And this is true for many small economies, many developing countries that do not have credible currencies or credible central banks. One can very well see digital versions of the dollar or perhaps even the renminbi, if it was widely available outside those countries, or even a stable coin provided by a company like Facebook being much more trusted than domestic currency. So I think there is going to be at least some reordering of the second and third tier currencies, which are going to face fairly perilous circumstances as these technological innovations take hold.
Yeah, absolutely. A very challenging situation for these countries. The second question, I think that this could be the last question, is related with the central bank mandate. That is, you highlight in your book how the financial crisis imply that the Greek financial crisis implied that the central bank mandates should change and put at the same level as price stability, the financial stability, take into account that their tools is not only the interest rate for monetary policy, but also they have tools on regulatory side. Now, with all these things that is happening, many other issues are rising, like promoting safety innovation, keeping a level playing field, but also with the CBDC, you open interesting question. Like, for example, on one side, it's possible to control or monitor or knowing more about what the people are doing with the payments. Then there are some things related with privacy that are clearly out of the scope of the central banks. At the same time, you are able to issue a spirit day or you are issue conditional money that maybe are decisions that are outside of the central bank. But at the same time, if you take all these functionalities, you are also you could also damage the credibility of the currency that is clearly inside of the central bank. Then I don't know how do you see in this framework the situation of the mandate of the central bank. But in some sense, should we make a deep revision of what should be our role in the future? Because there are many issues. We are taking decisions. We are analyzing many issues that are clearly out of our scope, but is very linked to some of our primary roles, like keeping the stability and the trust on the currency.
That's a very profound question, Jose Manuel, and it's going to be a tough one for central banks, governments, and societies to consider. CBDCs, provide a wide range of functionality. You can undertake helicopter drops of money into central bank accounts, which would be good at a very difficult time for an economy, and we've certainly seen a lot of perilous times in the last decade and a half. You could have, units of money being issued with expiry dates in order to stimulate consumption or investment. One of the benefits of a CBDC is you would pull a lot of economic activity out of the shadows and into the tax net. But you can very well see the government then beginning to use the central bank as an agent for many of the activities that a government actually should be conducting directly. And this could end up creating a very difficult circumstance for central banks, because ultimately what is crucial for central bankers such as yourself is the legitimacy and credibility you have because you are seen as independent institutions. If you get too tangled up with government policies, I worry that the core credibility and legitimacy and therefore the effectiveness of central banks could be compromised. And that is a real concern, even though CBDCs may be wonderful in many other policy-related ways.
Yeah, one final question or one final thinking on that. I clearly agree with you that is part of our legitimacy is if we are closely linked to our mandate. And even that you have, okay, maybe this thing could be good for the society. And for example, with all this thing related with the green finance, there has been some people claiming, okay, you should do some green QA because this will help the economy as a whole, but this is not in my mandate. And if I will jump my mandate, it's very difficult for me to have credibility and be trusted. Then this is critical for our reaction. But I found that in this discussion on, I would like to know your opinion on that. In this discussion on financial innovation and what is happening to the financial system, many times we focus on the transition, on how this is going to evolve. But I found very little discussion of what will be our desirable financial system in the steady state. What will be the final design of the financial system? And in this sense, and this is maybe not in our mandate, but it's something that we should think about. What will be the financial system that will be better in order to provide not only efficiency, but also things that are becoming more and more important, like economic inequality, avoiding gender or race bias, or providing a sustainable funding for the economy. Then I don't know how do you see this debate, this more long-term debate of what will be the roots of the financial system?
That's, again, a crucial set of questions that every society will have to ponder. The one conclusion I came to in the writing of this book is that while technology is going to have many benefits in terms of broadening access to financial products and services, it's going to be able to increase the reach of low-cost digital payments and so on. There is a risk, in fact, that you could have existing inequalities in societies being exacerbated, because right now digital access and financial literacy are very unequally distributed. Yeah. So all these wonderful innovations might end up worsening those inequalities. And the other thing is that technology is not going to solve all problems. Even in the narrow context of DeFi, I think governments will have to play a role in terms of providing the right sort of guardrails so that the benefit-risk trade-off remains a positive one. So I don't think leaving it to technology and the private sector is going to solve all problems and could create even more new ones. So I think governments are going to have to play a crucial role in making sure that this trade-off comes out the right way, not just for a small fraction of the society, but for society more broadly.
Thanks a lot, Iswar. It has been really a pleasure. I only can recommend everyone reading your book. It's really an absolutely amazing book in order to not only knowing how the financial system is working, how it's is being transforming, and how it could be impacted by all these things that are happening in the new technologies and the financial innovation, but also to think about these more profound issues, that where we are going and what are the main trade-offs that we are facing. That something is not on the table on the governments, and I think that there should be more discussion between authorities, government, financial regulators, private sector. That is one. I think one of the big implications is that cooperation, international cooperation, national cooperation should increase, and we should think in these long-term issues. And your book is one of the most absolutely best works to think about it. And I will give back the floor to Antonio, and just thank you for all your thoughts and for writing this wonderful book.
Thank you, Jose Manuel, for guiding the discussion. It was really enjoyable. And I also thank Jose Dario Uribe and his colleagues at FLAR for all the wonderful work they're doing on these issues in the context of Latin America, and to all of you who joined this discussion.
Thank you very much, Jose Manuel and Professor Prasad, for sharing your knowledge with all of us. To our audience, don't forget to register under the chat. You will find, you can click, and you have the opportunity to win a copy of Professor Prasad's latest book. And to all of our audience, remind that on Thursday we will have our final open session that will be held by the BIS Innovation Hub. The head of the BIS Innovation Hub, Benoit Couret, will be talking with our General Secretary, Fidel Jaramillo. Until then, stay safe. Bye-bye, and thank you.